next up, we've got a panel that's going to be focusing on innovative data center financing, portfolio versus ABS. So please do join me in welcoming our next panel to the stage.
So we'll get going. We have roughly a 50-minute panel. We'll see after the last one exactly what we'll get through. But this session will be about innovative financing approaches, primarily the dynamic between portfolio financing and ABS financing across asset types in the data center space. I'll do a quick introduction, and then I'll pass to my fellow panelists today. They can introduce themselves as well. So my name is Bora Gukbora. I'm a managing director based in the US, covering our digital infrastructure clients, our REITs, investor clients, our telecoms and cable companies, and data center developers, with broadly transaction support and portfolio value creation opportunities. Chris?
Hey everyone, Chris Moon. I'm a managing director at DigitalBridge Credit. I joined DigitalBridge about 7 years ago to start the credit platform, where essentially what we're focused on is extending credit to exclusively into the digital industry, the digital infrastructure industry, focused on fiber, towers, small cells, and most importantly, right now, spending a lot of time on data centers. And we cover the U.S. And Western Europe as geographies for this. We manage about $5 billion of AUM in credit.
Hello, my name is Ivan Paja. I am CFO at Naviax. Naviax is less known than DigitalBridge, but it is one of the leading players in Spain. We own, develop, and operate assets, have 3 different sites, 2 in Madrid and 1 in Barcelona. And the total capacity now is around 40 megawatt IT, and we are in the process to construct additional 80 in next 2 years.
My name is Michael Huber. I'm a principal in the Special Situations team of Bain Capital, based out of London. As a firm, we invest primarily in data centers, besides a lot of other things, globally in Asia, in Europe, in the US. Personally, I cover the digital infrastructure data center space in Europe, or EMEA for the firm, with, on the one hand, working with our portfolio companies, especially with H-Scale, our hyperscale platform in Europe, as well as on the structured solution side, where we provide tailored capital instruments to other sponsors and platforms in Europe.
My name is Martijn van Beek. I co-head the digital infrastructure financing business at ABN AMRO. ABN AMRO is one of the leading banks in the digital infrastructure sector in Europe, and we cover data centers, fiber, and telco towers.
Hello, my name is Wim Steenbakkers. I'm the global lead for technology clients within ING, which is partly digital infrastructure on the satellite and data center side. We also cover software, hardware, IT services, and AI-related type of businesses. So looking at the whole value chain.
Great. Okay, so again, today's topic is portfolio financing versus ABS, but as we were discussing as panelists and working through this, it's really a fundamental question we're seeing is what exactly and how are investors underwriting data centers today, especially as they become more heterogeneous across the different asset types, neoclouds, edge, colo, hyperscaler. It's quite diversified, and so we'll also explore that a bit today as well while staying grounded to the core instruments here. A little bit of an opening for me. So, I mean, historically, data center financing was largely about underwriting things like power, location, utilization, and visibility to contracts. That obviously drives cash flow durability because of workload durability, and that drives different needs for different transaction types across portfolio and financing. And we expect that diversity to only grow and continue in the space. And so, within BCG, we're definitely handling this opportunity between investors as commercial diligence, transaction support, and technical diligence all emerging as one topic. It's very different to underwrite compute versus land and leases. So I think to start the discussion, it'd be great, Martin, can you just ground the audience and define the difference between portfolio financing and ABS financing and any sort of the nuances that you think are important?
Yeah, sure. I think both things solve different problems. So ABS is all about maximizing proceeds and lowest cost of capital for stabilized assets. And you can get the proceeds in the institutional market. Whereas portfolio financing is all about flexibility and growth. So in a portfolio of data centers, typically it's a mix of stabilized assets, assets that are still ramping up, and further greenfield development assets. But the diversification in such a portfolio in terms of offtake, in terms of location, but also benefiting from the cash flows from the stabilized assets allows lenders to grant more flexibility in terms of the development. Seeing ability within a portfolio financing to allow different types of off-takers to have a bucket for speculative or forward-starting investments. And so it's more focused on the growth of the platform. How do you fund that growth? Whereas ABS is really about how to best monetize the stabilized assets.
Got it. And Wim, beyond structure, like what is driving the industry's growing interest in ABS? Maybe you can speak a bit to what you're seeing in Europe and the adoption and maturity of ABS as a product.
Yeah, so I think indeed, as Martijn said, there's two distinct phases. So development effectively takes place in the portfolio financing, and then when the assets stabilize, when banks effectively need to recycle capital, some of the equity sponsors need to recycle the capital, then the move to ABS is a very functional, very attractive way to do that. It also provides a longer term financing for the stabilized assets. So that's obviously, whilst project finance, I suppose, started for data centers in Europe, then moved around the world, and I think is kind of excelled in the US at the moment with very large size transactions. In Europe, the market's been a bit slower, I think, and therefore the drive in the US to recycle the capital has been stronger, and the mindset on securitization is obviously a lot better in the US markets and much more receptive for that type of structures. And Europe's following. So now it's kind of reverse. I guess we'll touch on more of the securitization techniques later, but there's a pretty big difference between the depth of the market and liquidity in the US and the European market.
Got it. Okay, so I think it's a good time maybe to transition to you, Chris, in terms of how investors are underwriting data centers broadly. Tell us about how you're seeing the different assets play out from an underwriting perspective across hyperscaler, colo, and any of the other emerging asset classes like NEO and GPUs even.
Yeah. Just to touch on the point Wim was making about, where the demand from the ABS market's coming. And I've been thinking a lot about this because, the leverage that you get into these structures, the pricing that you get is extremely favorable to the issuer. But digging down to what's driving, the investor appetite for that, it's really the ability to access for institutional investors to be able to access this asset class, which is easiest for them to do in a fixed rate format because they're managing long-term liabilities. So I think even if you see, like we've seen these massive disparities in Oracle risk, short-term construction loans can't get priced or they're being sold at a discount from the banks, yet long-term fixed rate Oracle bonds are 9 times oversubscribed, 30-year T plus, 45 basis points or 100 basis points. So the difference in the market between fixed and floating is massively disproportionate, and it's really being driven by a lot of this institutional capital that wants to enter, but it's very, very difficult for them to do that in construction loans or, prepayable short-term floating rate issuances. So sorry to detract a little bit, but I think that becomes a little bit of an underappreciated point. In terms of how we're thinking about underwriting sort of the different flavors of data center exposure. So we've done a lot in GPU financing. We were in the first CoreWeave GPU financing deals that were ever done. that were structured together with Blackstone and Magnetar and Co2. We've kind of, I guess, maybe pulled back a little from that as pricing has gotten really tight there. I think there's a lot of complexity in having a lien over just the GPUs within a data center. My preference would be, my strong preference would be to own the entire box and everything inside, so that in a default you could lease out compute in sort of a fungible, commodity-like fashion. But accessing the data center, and then if you have a defaulted data center and a defaulted GPU loan at the same time, you've got two different lender groups that are, both in default, kind of needing each other, fighting each other. It's a really awkward position to be in if you really play that out. I have no understanding of how the rating agencies, can put a investment grade rating on a GPU vehicle, where essentially you're replacing all of the assets every 5 to 7 years. So that's new to me, but that's getting done. That's new technology in the market, and there's a lot of appetite for those that follow the ratings as kind of the beacon of trust. And then on the data center side, we sort of play a little bit more in like we did XAI recently. So sort of non-traditional tenants. There's a lot of capital, a lot of infrastructure, but we're sort of coming into a transaction like that where you sort of haven't really proved out the model yet. You don't really, you don't have a hyperscaler tenant, and then we'll also finance a lot of non-traditional tenants, like or sort of non-conforming, I guess, non-investment grade. I think the key for us is we believe we're operating in such a compute deficit that in good markets. So I guess this is a long way to answer the very simple question of kind of what the key thing we look for is.
I'm not sure it's that simple, but yeah, it's good.
The market really is, because ultimately, if I get stuck with a data center, the tenant is really important, but then the next layer of that is, okay, what do you do with it? If you're in a market that's extremely supply constrained, extremely power constrained, then even if I get the data center back, without a paying tenant, then I can still monetize it and recover my principal. If I'm in a market where all I'm doing is relying on a tenant and there is no fundamental business case for the market itself, that's where I think for me personally, I get a lot more nervous. So we're doing a lot of like land financings in Ashburn and Reno and top markets. We're doing we're pricing in a lot of cases loans to these sort of tenants that nobody will extend credit to, and I just price them essentially at spec risk, and then sort of operate indifferently into whether ultimately they default or not.
Got it. And so, Michael, for you, as you look across the different flavors of data centers, how do you view their natural fit into the different debt structures, which require different approaches to financing from your perspective? And maybe you can give us some color on the different thresholds you see.
Yeah, so I would say the capital markets definitely differentiate well between the different, call it data center sub-asset classes that you have between hyperscale, colo, like portfolios, edge, GPU, etc. So, and maybe if we take it from the spectrum of the sort of the most cash flow oriented ABS down to the other end of the spectrum, I would say they're sorting themselves pretty well into distinct buckets. So on the securitization ABS side, you want predictability of cash flows, you want duration, you want investment grade, high quality counterpart sort of profile. And so that's a natural home for hyperscale where you have exactly that. Then portfolios, co-location, where you don't have a single counterparty, but you have a diversified portfolio of facilities all across the country, multiple assets, a high number of tenants, where sort of the law of large numbers kicks in. So you don't have one single lease, but sort of the mix of your customers underlying does that for you. That works as well. And then if we move over more to the edge side, where you have much smaller facilities, more dispersed, latency sensitive, but kind of shorter lease terms, it's a little bit less tangible for sort of the cash flow oriented folks. And so you're probably now crossing over into the platform corporate finance territory as a better fit. And then if you look at neoclouds and GPU, I think it's new territory in a way, and we've seen a couple of different solutions being provided in the market, both on the securitization side, where effectively you're looking through to who's your covenant behind, and it's more of a tenant credit lease type of approach, or you have sort of highly speculative alternative capital or primarily equity funding actually on the other end of the spectrum. I think there it's less clear, but we'll see how that evolves.
Quick double click into the neocloud piece. So when you're looking at the counterparty behind the workload, what kind of information can you gather as part of the underwriting? What does that look like from your perspective in understanding who's behind them?
Yeah, this is actually one of the main challenges, because in most cases, the most desirable customers will have the most stringent non-confidentiality requirements. And so there is maybe a little bit of vague messaging that's possible within the art of the possible to get a sense of who's behind and sort of get a more comfort from a sponsor or from an owner's perspective. But if you go to the market and you want financing, and your lenders or the capital markets, they actually want written information, that's where it gets very tricky. So in some cases, you don't get much information. And I think including in the bank market, when you get more project finance style loans on sort of hyperscale pre-leased facilities, I think sort of the borrowers and the lenders are sort of working in a very pragmatic way to deal with that reality.
Got it. Okay, changing gears slightly, Ivan, we'd like to hear from you as the operator on stage. You recently executed a pretty significant financing to continue to fund your development expansion in Spain. Could you tell us a bit about how you perceive lenders and investors in terms of how they're evaluating different assets and ultimately executing their financing across portfolio and ABS?
Sure. Well, the approach followed in Europe differs from the approach followed in the US. We are lagging behind in terms of financing. In the US, it's much more developed ABS, whereas in Europe, portfolio financing is the leading way to finance these kind of assets. But once it's true, even in Spain, we are also much more in banking mode. And our experience is that we have so close relationship with commercial banks that we usually achieve similar or in sometimes better conditions for commercial financing than what we have seen in other kind of financings like bonds or ABS. In our case, we have 3 assets, and therefore we decided to go for a portfolio financing. We received huge, massive interest from commercial banks, not only Spanish but European ones, and there are many of them with which we had not previous experience. French, Norwegian, German banks with impressive interest in financing data centers. The reality is that in Spain, there are not many portfolios like ours, and therefore banks wanted to have an interest there, and that helped us to reach quite good terms and conditions from them. The execution was very quick. We were able to secure a term loan which allowed us to refinance a previous loan we had, and secure a CapEx facility to start construction of the new data center we are developing in Madrid for 80 megawatt. This will be a bridge loan, and then we will obviously move to a term loan, or even we will consider other kind of financing as ABS, because at that moment we will have enough scale to go for it, whereas as of today, it was impossible for us. So, well, I think it depends on the moment. Once you have stabilized assets, ABS may work. But in our case, that we have a portfolio of operational assets, but a huge pipeline of projects that we are developing and constructing, portfolio financing is much more interesting.
Got it. Martin, Wim, it'd be great to hear from you about this point from Ivan around ABS scaling. Can you tell us, like, why has ABS scaled much faster in the U.S. than Europe? What presents Europe as behind? And do you think Europe's curve will behave the same way as what we saw in the U.S., or will it top out at a different place? Why don't you both tell us about the different mechanics at play?
Yeah, sure. I think there's two things. It's on the one hand, it's Europe is behind on the maturity curve, but two is also the markets are just structurally different. And so the US has always been more of a capital markets environment, whereas Europe has a very deep banking market, and that is not only the case for data centers. That's true like across the different sectors. So historically, there hasn't been too much need for data center operators to go into the capital markets because there was just so much bank liquidity still available and at attractive terms. I think now, as you see the business scale, particularly for the larger operators, they've reached bank facilities of 6 billion or even more on the largest portfolios. There's more and more the need to diversify their funding and also tap the capital markets, especially considering the pipeline that they have, where there's massive capital still required. So there's now more pressure, and I think Wim touched upon that earlier as well. There's now more and more pressure for operators to start tapping the ABS market, and that's what we've seen in the past years. There have been the first ABS issuances in Europe. So it's a market that is evolving.
Yeah, I think the biggest difference is the capital market structure. So the European market is not a single market, as we've seen and been told over and over again. What we can make in Europe is what we see in the US. I think, as Chris explained, the depth of the institutional market we can create in Europe. At the moment, if you look at the ABS market in Europe, we see single country almost issuances, and that's for a reason, because the legal documentation is just simply getting to such extent that it's no longer feasible to it. And the European securitization market therefore is always linked to one large market and maybe a carve out for some adjacent markets, but nothing more. I think the drive, and as many reports stated, we need to create that capital market, and I hope that will happen, because then I think we'll be able to very, very quickly turn around capital and spur growth in a different way than we've seen today.
Got it. So, Chris, as the credit investor in the room, do you agree? What role does private credit play, and do you think Europe will eventually converge to the U.S. model?
Hard to say. It seems like Europe really hasn't embraced, the institutional capital that we see in the U.S. Whether it's hedge fund capital or private credit, or unsure. If that'll play out over time. I think that we tend to. Our geography coverage is U.S. and Western Europe. We've done almost nothing in Europe. I mean, as some of the panel members here have just talked about, it is a heavy bank market. I think the relative value as a credit investor is so much better in the U.S., whether it's in fiber to the home, whether it's in data centers, or a variety of flavors of digital infrastructure assets. So we see a lot more activity here. The market is just a lot more resilient, and I think really where our edge comes in is mostly around speed and certainty. We just make a lot of money by just being there, and understanding the business and being able to write a check in 30 to 60 days without having to run a long bank process. And I think because there have been so many demands for capital, it's required just lots of innovation in the market. And again, we have these two dichotomies. You have the short-term liability managers, which are the banks, and then the long-term liability managers, which are the institutional investors. And so, it's not that easy just to slot in, and solve only with price, a loan that's set up for short-term. A perfect example of this is we recently bought a construction loan for a non-investment grade tenant that was brought out by the banks, and essentially there was no bid for it. We bought it at a very deep discount, but there was essentially no other institutions that would bid for it because it's essentially going to be an 18-month loan, which just doesn't fit. Just doesn't fit our form of capital. So it's requiring a lot of creativity, and I would say the biggest problem that all of us have to solve is what do we do to take out all of the stabilized data centers that we'll start to really see accumulating in 2028, 2029, 2030. It's just the takeout of all of those construction loans is vastly, more larger than the ABS market and the private placement market today. So there has to be some, evolution there, or else, we've got a lot of construction loans that are going to have nowhere to go.
Got it. So we're talking a bit about kind of the risk of these different loans and the depth of the market required. I think it'd be good, Michael, to hear from you, and maybe Martin as well. Portfolio financing in principle is presented as diversification, but where does the risk actually sit within a portfolio? How is it reduced, redistributed, or blended, and even subsidized?
I think the main principle or the main advantage, especially from a borrower's perspective of a portfolio financing, is ultimately you can get additional proceeds that you can put to work on parts of the portfolio where you would otherwise not be able to raise financing on a standalone basis. So if you're asking in a portfolio financing, are good assets or de-risked assets subsidizing risky assets? Yeah, that's the case, but it's probably also the purpose. And so from a lender perspective, for example, maybe with a borrowing-based facility or just a broader portfolio financing, they understand that, and so they're giving you additional headroom once there is a sufficient pool of stabilized assets with cash flow, and maybe behind that, unstabilized, like under construction but leased, that are coming on, and then there's a pocket created for speculative or more risky assets. And so you have cash flow, reliable cash flow, that will effectively secure the lender against typically a small exposure of speculative dollars to work that is not cash flowing. And so it effectively is bridging the period to lease on that. And then as the portfolio matures, often there's additional borrowing base created. So I think the critical elements is probably if you put together a portfolio financing and you have sort of a pool of assets underneath that portfolio, what does it look like? And when it's underwritten, does everybody understand what the portfolio looks like and what it behaves? And so I guess if, especially the lenders understand the characteristics and the profile of the portfolio and the average metrics of that financing or of that portfolio is not grossly misrepresenting sort of the underlying composition, that's okay. But I think you can probably have cases where maybe it's a sort of a lack of diligence or consciously perhaps, but where you have a handful of very strong assets that create strong portfolio level metrics, but in reality you have also a weak tail of assets for one reason or another, where if you do have that, often the fundamentals deteriorate over time. That could be problematic, right? Because the idea of a portfolio financing is strong assets, subsidize or enable you to push ahead non-stabilized assets, speculative assets, and that sort of the strength and the maturity of the portfolio as a whole sort of improves over time, rather than the other way around. So I guess in terms of risk, the latter case with a tail, nobody wants that. That's probably an underwriting error, or maybe it's a market shift, so that's maybe an inherent risk to that. But in principle, the purpose of a portfolio financing is to allow a borrower to allocate funds in a more efficient way, where on a standalone basis, a particular kind of financing wouldn't be available for some of these assets sitting in a pool.
Got it.
Well,
Okay.
I completely agree with you because, well, in our case, for instance, we have 3 assets. The main one represents around 60% of the total capacity EBITDA, and the smallest one is less than 10%. Obviously, the best performing asset is the largest, and that gives confidence to lenders, and that allows for these portfolio financings. Before our sale of assets in Latin America, we had a similar portfolio financing, but in that case was even more extreme because we had 6 different geographies with different currency exposure. And obviously in that case, the extreme cases are more material. But even in that case, lenders got confidence enough to provide us that portfolio financing.
Before we turn to questions, which I see are starting to come in, I did want to do a quick rapid fire round. So 1, 2-word answers maybe to each of you on the following. What's one underwriting assumption that you believe the market is getting wrong right now? Chris?
Loan to cost on data center builds. The cost per megawatt is coming down. It's reverting closer to $5 or $6 million a megawatt. Modular data centers are real, in my opinion. And to all these people that are stuck at like 10 million of debt per megawatt and have any renewal risk, that's the biggest miss, I think.
In my view, potentially residual value.
Of GPUs or something else? Or
On everything, I would say it's not that it's wrong on everything. It's just that you got to differentiate and be very thoughtful in how you look at residual value and sort of how you determine that. And that can vary wildly depending on the sub-asset class, but also for strongly leased or maybe a portfolio of data centers, location specific, right? I think Chris mentioned at the beginning, if you have something you have a shell, power, etc. in a location that is very constrained, you care less about the cash flow and sort of the creditworthiness of your
qualities,
customer.
the criteria.
So you have to look differently about what's your residual.
Got it. Martin?
I'd say durability of some of the older colo assets. I think we're underestimating some of the refurbishment costs that are coming to keep them up to spec.
Good. All right. Over to the screen. To the banks and lenders, are you increasingly finding yourself competing with the Middle East and Asian sovereign funds in the in the Middle East and Asian sovereign funds in the US and Europe? Does this change your approach or your ability to capture value?
Well, I mean, this is what I'm talking about when I talk about institutional investors. I mean, these are the investors in our funds. We have essentially every Gulf and state investor and Asian sovereign in our complex of investment management products. And it's really through GPs like us that a lot of those parties are working through to compete directly against the banks.
Yeah, for underwriting banks, I think it's a new or relatively new pocket of liquidity, so that we can use to syndicate, and we probably need, as other lenders are capping out on their limits. So people are trying to find the new pockets of liquidity.
Exactly. I would say they're not structuring deals, or they're not leading deals, but they're definitely participating in some of the deals that the European and US banks have structured. But they bring significant liquidity with them, and that is very helpful in the market where we need a lot of capital, and they tend to follow the investors that Chris alluded to.
I think we can wrap if there's no other questions from the audience. Any final comments or questions? Here we go. What is the minimum size of financing at which ABS becomes relevant in the European context, and which countries are better suited for this type of financing?
It's probably $300 million to $500 million at the low end, and it would be all the developed Western European countries.
I would say the sweet spot is about 500 to 600 million euros in Europe. And I'm not sure there's, I think we can fit it in most of the countries. The difficulty is a pan-European ABS.
Across countries,
Yeah, multiple,
right.
multiple
jurisdictions.
Exactly. So the ABSs that we've seen are single jurisdiction, single campus. That works well at the size of indeed 500 million roughly.
Is there a chance for it to get aggregated at like a larger campus? Even if it's a pan-European distribution, can it just be a single facility perhaps, or a single campus?
But I think that's one of the biggest problems with the ABS. The ABS is most allergic to concentration risk. And so diversification is sort of the way that, that's what you need to make the entire model work. So a single site starts to get very complex.
So the multi-jurisdiction attributes of pan-European then fights against the diversification needed. That's the main tension.
I think a multi-site project in one jurisdiction would be the ideal ABS.
Okay. Well, I think that's it. Well, thank you, everybody. Hopefully you enjoyed the session, and thanks again for your time.